right, so we're at 5:30. We'll probably give it like another minute, I'd say, to allow some attendees to join. Then I'll go ahead and do a brief intro and touch on some housekeeping points, and then I'll throw it over to John to go ahead and start with the introduction. As I mentioned before, feel free if you have a question, raise the hand, or you can utilize the microphone. Also, the chat function is there, so you will have the ability to ask questions through chat and Q&A. We'll get started in about, let's say, about 15 seconds. And we'd love to hear from you, from the attendees, where you're from, what type of business you're in. If you'd like to drop that in the chat.
So we know Susan has a photo booth business. That part we know already.
All right, so we'll go ahead and get started. I know we have a solid agenda. So good evening, folks. Welcome to today's webinar. It's the final session in our Business Start series, brought to you by the Sacramento Valley Small Business Development Center. My name is Joseph Cordova. I'm the program coordinator with the Sacramento Valley SBDC. Just a couple of housekeeping notes. As I mentioned before, utilize the chat. If you do have a question during the Q&A portions, go ahead and use that microphone. And we also have the Q&A box if you'd like to ask your questions throughout that point. So what I'm going to do now is I'm going to hand it over to the host, John Goldberg. He's an SBDC advisor. Go ahead and take it away, John, and have a great show.
Well, thank you very much. I'm glad to see some familiar names on here, and I think I even might remember Lucia's photograph. I can't remember. And we do have two guest speakers today, Colleen Morris, who's a bookkeeper in the Yuba-Sutter area, and she's going to be speaking near the end, and then we might have Brenda Stranix to give some closing remarks, obviously at the end. So let me see here. Let me just go over the slides. I'm going to go back over to screen sharing and share the screen. Oh, wait, sorry. Have to redo that because I have to enable sound when I share the screen because we got a couple of short videos we're gonna do here. Let me just go back to screen sharing, and then this time I'm going to click share sound and click which one I want to do, and now that should be up on the screen, and I'm going to make it bigger. There we go. So can everybody see the introductory slide?
Yep, we are seeing it, John.
Great. Okay, so this is the fifth and final. You know, when Joseph said the word final, I got sad because I'm going to miss everybody. But it's the final in the Starting Your Business series in the Yuba-Sutter area. And this is sponsored by just a host of organizations, four actually. And they include the Sacramento Valley SBDC, Small Business Development Center, also the Yuba-Sutter Chamber of Commerce, the Yuba-Sutter Economic Development Corporation, and Yuba County Enterprise Solutions. So very grateful for the support of all those organizations and for the participation of everybody who's here today. Slides don't want to start going, don't want to go yet. So very important to say at the beginning, this disclaimer. I read the whole thing the first time. I won't do it this time. But basically, what I want to tell you is I'm not a lawyer. I'm not an accountant. I'm not a bookkeeper. So if you want financial or legal advice, then you should get it from a professional in those areas, right? I'm giving you information, and SBDC and the other organizations, we're just not taking any responsibility for any negative consequences that may occur by people using information from the interview. That's the disclaimer we always have to say. Okay, so like I said, this is the fifth and last. We've been at this since October 11th. We started with starting your business, planning your business, financing your business, marketing your business, and now we're back to finance. And this is called actually understanding and managing financial statements, but that was sort of long, so we shortened it just a little bit. And I want to say I'm really glad that this is set up as a meeting rather than a webinar this time, because those of you who want to speak can. I don't know whether you'll need to get Joseph to unmute your mic or whether you can do it, but I see that that's a possibility. And so if you've got questions, feel free to just jump right in and ask them. Okay, so we're going to talk about financial management for your business. And the thing is that financial education is very important for entrepreneurs because entrepreneurs are usually all about, except maybe for Colleen, because her business is about finance, right? But most of us, our businesses are not about finance. So we're into what our business is. Like recently, I was the CEO of a sunscreen company startup, and we were all about sunscreen, right? So that's what we were focused on. But we also needed to be focused on the finance because we needed to raise money. So it's very, very important to have a basic knowledge of finance to be able to run your business. So the agenda today, first of all, we sort of did the course overview. Then we've got some financial realities for small businesses. They've had a hard time, 2020, 21, to some extent in 22, but businesses are getting back up again. That's a good thing. And then we're going to talk about the big three financial statements. I'm going to cover them, in a basic sort of way. And Colleen is certainly welcome to chime in as we go or to expand on it when we get to her part later on. These three are the income statement, the balance sheet, and the cash flow statement. And then we're going to talk about some key financial concepts and then and some strategies to improve your cash flow because that's very important. Cash is king, right? You run out of cash, you're in big trouble. So that's the the agenda, and the objectives include you being able to have a basic working understanding of the three most important financial statements for a business. You will need these for a loan. You will need these for an investment. You might need them for lots of other things. And we're seeing in a very famous court case right now some of the possible consequences when you get these things wrong. So it's very important to know how to get them done right or to work with a professional who can help you make that happen. So also it's important to have a key working knowledge of, key financial concepts and terminology. I'm sorry, I just can't resist telling you this. I had a friend who got a certificate, like a graduate certificate in nonprofit management. And one of the courses she had to take was accounting for nonprofits. And the professor at a really very prestigious university who was teaching this um, said two things I'll never forget. One is, I'm not going to teach you how to be accountants. I'm going to teach you to know how to defend yourself from your accountant. The other thing that the professor said was that if you're doing for most financial statements, like for example, a balance sheet, you got two sides and you're putting stuff in the two sides. And he said the two sides are damn its and cram its. And the funny thing is, that's all he ever called them. And it wasn't until months or even maybe years later that she found out that they're actually debits and credits. We're going to talk about some key financial terminology, concepts and terminology in this course. And like I mentioned, some tools to improve your cash flow. Okay, if there's any questions about, the agenda or the objectives, glad to entertain them. Otherwise, I'm just going to keep right on going on. Okay, so we're going to talk about financial realities for small businesses. So every decision you make is going to impact the financials of your business. The survival of your company will depend on your knowledge of how to manage the money. When the money's the worst and you want to run and hide, that's the time you need to up your game and lean into it. So here's some questions. When can I open? Or when can I get into full operation? How much business is going to come in? 25% of what I expect, 50%, 75, 100, 125. How much business is going to come in? How long is it going to last, right? Like businesses are cyclical. Some do well at first, they don't do so great later. Some of them, they start slow, they get better later. So how long is whatever is going on in your business going to last? What about your lease? What's going to happen with that? I know somebody who just rented, she's a coach, and she just rented some office space in Midtown Sacramento, which is very expensive. She got an incredible deal, $350 a month. Now she's got, a tiny little office, but still $350 a month. But in like 3 months, it goes up to 400. So, 400 is still cheap, but it's not 350. So leases always change when they renew, right? They can change. What's going to happen with your employees? Do you have employees now? Are you going to have to hire employees? What's going to happen with all that? What's going to happen to your hard costs? Hard costs are things you have to pay every month, no matter what, right? And any other expenses you have. So those are all the questions that are going to be coming up as you're starting and running your business. And you need to be able to answer all these questions in a satisfactory way. And how will new initiatives impact the bottom line? Maybe you have a new product, maybe you have a new service, maybe you have a new territory, maybe you have a new customer, whatever they might be. How is that going to affect your bottom line? Sometimes new things are good for the bottom line, sometimes they're not. So it's good to know how to figure all this stuff out as you go along. So now we're going to get into one of the main parts of this session tonight. And again, if there's any questions or comments, just put them in the chat, or if you can, just shout them out and we'll try to address them. So we're going to talk about the big three financial statements. The first one's the income statement, and we're going to spend more time on that one than the others. So an income statement is a core financial statement showing profit and loss over a period of time. So I'm going to give you, you're going to get these slides, and you're going to get all these links. But what I'm going to do is I'm going to show you some of them that you're going to be able to go to and see. So there's something called the Corporate Finance Institute. They've got some great information for lay people, right? About about all this kind of stuff. And so it says, what is it? And here you've got, hold on, revenues, expenses, and profits. And then here's an example of one which you're going to have a chance to work on in a few minutes for yourself. You can download that, but I'm going to give it to you without downloading it. So you have to give me your email. So there's all that information for you, which we will go over in just a moment. And we're going to watch this video, which even though the audio is a little weird, I think it does a good job of explaining what an income statement is all about, how to use it. So let's watch the video. If you can't hear it, let me know. Or if you can't see it.
Now let's look at the income statement. The income statement can also be referred to as the statement of operations, or the statement of profit and loss, which is sometimes shortened to P&L. When you think about all of the transactions that a company records during a period, you can see why it's necessary to have a statement that's dedicated just to the operations of the business. While in theory it could be possible to record everything on the balance sheet under retained earnings, we realize that really it requires its own statement to keep track of all of the income, all of the expenses, and all of the resulting profits or losses. Let's look at the income statement in more detail. The income statement starts at the top with revenues. Revenues can also be called sales or turnover. It represents the income that a company receives for selling goods or services. Below revenues, we have direct operating expenses, such as purchasing inventory. This line is often called cost of goods sold or cost of sales. This is the first expense line on the income statement. After deducting cost of goods sold from revenue, we arrive at our first subtotal on the income statement, referred to as gross profit. Gross profit is equal to revenue minus cost of goods sold. If we take the gross profit and divide it by the revenue, we calculate the gross profit margin. Next on the income statement come the indirect operating costs. These include things like research and development, administration, selling, and distribution. Several of these line items may be grouped into one, sometimes called selling, general, and administrative expenses, SG&A, or just general and administrative costs, G&A. If we take revenues and deduct the direct operating costs and then deduct the indirect operating costs, we arrive at the next subtotal, operating income. The terms profit or earnings can be used interchangeably with income. Operating income is often referred to as EBIT, which stands for EBIT, earnings before interest and taxes. Below the operating income line on the income statement, we can then deduct the cost of debt financing. This includes interest expense and bank charges. After deducting the cost of debt finance, there is often another subtotal for earnings before tax. Below that, taxes are deducted, and finally, we arrive at net income, the bottom line. Net income can also be called net earnings or net profit. This is the bottom line of the income statement, which then feeds into the retained earnings account on the balance sheet.
Okay, questions or comments about the income statement?
John, I'll chime in once here.
Yeah.
Oftentimes, business owners will come to me and say, I show $50,000 of net income. Why is that not in my bank account? And that is because the income statement is never your cash statement. And what is on your cash statement could also vary by things that are on your balance sheet, such as loans, the principal balance that is paid against loans, and the balances that are drawn by the owners. So this income statement is to be used as a portion of a detailed portion of what feeds into your balance sheet, but definitely not to be used as this should be the number in my bank account.
Okay, very, very helpful. Thank you very much. Okay, so I'm going to show you some examples of the income statement. They can look lots of different ways, but the most important thing is you got revenue, cost of sales, operating expenses, net profit. You got to have all those things, on there, right? But they can be set up in different ways. So here's one that's by month. So this one is, the one up above is, I guess, for a year 2017 in this case. This is by month, January through December, and it has a year-to-date total as you go along. This year-to-date right here, it's for a certain year. Here are ones that are for multiple years. So you're doing it for each year, right? So this is before this was done, and then you can forecast, right? You might do it on a, not necessarily a straight line forecast, but you might say, well, we've grown at this percentage, or we've got this many new clients, or whatever it means this. So this is how you can decide how that's going. So now here's net earnings down right here. All these numbers at the top look great, like that's what you're taking in, but this is the net earnings. So that's obviously much lower. And then there's three more. And like I say, you're going to get a copy of all these slides. You're going to have all these different examples that you can take a look at and see which one, works best for you. One more example, and then I think it's going to be your turn. Nope. Oh, wait, okay. Some more information. So there's only three things you can make if you want to have more money, right, from your business. Only three things you can do. You can increase revenue. You can decrease the cost of goods. You could buy things for less expensively, whatever. Or these are in bold. Or you can cut your expenses. And those are the things that are going to make a difference for your net operating profit, which is at the end of the day what you're going to most probably care about. Okay, so you want to take a look at a trend analysis. So you want to see, are you going up? Everybody's business wants to go up, right? Or are you going down? That way you can forecast what it looks like is going to be happening, and then you can make course corrections if you're going to, try to figure out how you can do better. A variance analysis. So variance means how much basically that this line jumps up and down, because the more it jumps up and down, the less predictable it is, right? It'd be nice if it was more like the trend line, because that way you can really predict what things are going to be like next month or next year. Another one is a year-over-year analysis, and I showed you those. There was one that said, here's the income statement 2014, 15, 16, and that gives you a picture of how you've been doing, which might also help you forecast about how you're going to do. Also month after month. One of them was January, February, March, like that. Now, seasonality is very important. So like I say, so I was involved in the sunscreen company, and we could reasonably expect that we would have more sales in the summer. Now, of course, there is the southern hemisphere, but lots more people live in the northern hemisphere, and especially using sunscreen, a lot of fair-skinned people all across the northern hemisphere. And so, and higher incomes in North America and Europe. than some other places. So in general, I think it's probably true that seasonality would affect the sunscreen business, and you would we would be making a lot more money in the summer and a lot less money in the winter. I've always thought that it would be really good if somebody had a store that sold sunscreen and umbrellas. Because that way, well, for one thing, the umbrellas can help with the sun, but then when it's not sunny and it's raining, then you can still make money selling umbrellas, because they have usually a different season, at least in California, than the sun. Okay, so I want to talk a little bit about gross profit versus net profit. So gross profit, as was mentioned in the video, gross profit minus total sales is the cost of goods sold. The net profit equals total sales minus cost of goods sold, and as the video mentioned, overhead, right? Which is like the administrative and etc. expenses. And the cost of goods sold is the direct cost of producing the goods. So for example, if we were making sunscreen, it would be the sunscreen itself and the containers that it went in. That would maybe some other packaging, right? That would be the cost of goods sold. Now, I didn't really like it when the video said you can call it the cost of sales, because in my mind, that's the cost of your sales force and what they do. So I find that a little confusing. But at any rate, the cost of goods sold includes the cost of materials and labor directly used to create the good. It excludes all other indirect expenses such as distribution and sales. So that comes from Investopedia. Okay, so let's talk a little bit about restaurants. Anybody here have a restaurant? Put something in the chat or just shout it out if you have a restaurant. So restaurants, and actually food businesses in general, grocery stores have very, very low margins. Many restaurants do too. And the reasons are that their costs. Labor is expensive, food is expensive, and overhead is expensive. They got a lot, have a lot of, they have a big utility bill, and they have to always make sure, big cleaning bill. They have to make sure everything's nice and clean, so they don't have a problem with the health inspector. So, for example, restaurants may bring in a lot of money, but they may have relatively low profits. Oops, sorry, I was bouncing around. Whoa, what is happening? Okay. So I would like, given what we've talked about so far, what are some ways to increase revenue? Maybe let me take that back. Not given what we talked about so far. Just think about what are some ways to increase revenue in a small business. So if anybody would, please put your thoughts either in the chat or just shout them out. Let's see what we got so far in the chat from before. Oh, so I'm a little confused. Somebody asked, will we be able to get a copy of the slides? SBDC said yes, but you will be sending them to, and somebody said no. I assume it was about that. Or maybe it was no restaurant. I mean, it probably
Yes,
was
that was my answer to the restaurant question.
Okay, thanks. I was worried that you hadn't gotten slides from a previous session. So anybody at all want to talk out loud or put something in the chat about how do you increase revenue in a small business? Good, we got something here. More customers, absolutely. That's probably the best way to get more revenue, right? More customers, and also upselling, selling more to the customers that you have. And then the other thing is to have different income streams, right? You could have, let's take some kind of a therapy business, right? So you might have your main source of revenue might be your clients, but you also might make videos, and then you get money from subscriptions. Let's see, I'm just trying to think of another thing you might be able to do. It's not coming to me at the moment, but basically, if you have different products or services, you can get more revenue that way. Back to the slideshow. So pricing, we can have a whole session about pricing. In fact, there probably is one in the training catalog. So you have to ask yourself, are you charging enough, too little, or just right? Sometimes people think, oh, I'm new and I got to charge low because when I get into the market. But then people might think, well, this probably isn't very good if it's so cheap. Sometimes premium price, that'd be value pricing, right? Sometimes premium pricing is better because then people think, oh, this is expensive, so it must be good. You might actually sell more if you have a higher price. Oftentimes you sell less, but you could possibly sell more. And just right pricing would be Goldilocks pricing, or otherwise known as parity pricing. So what you have to think about is, what is the optimum mix of products and services to maximize your revenues and your profits? So like I said before, you might want to have multiple products, you might want to have multiple services, or a mix of both, to get more money in and then to have more net profits, right? But you have to think about what each of those is. Like, for example, I used to work for Chiquita Brands International. Now, it was primarily a banana company, but it went into the pineapple business big time. And it also bought some other businesses. It bought the largest meat packing company in the United States, and it bought the largest private label vegetable canning operation in the United States. And why did they buy them? Because they thought they could get more revenue and more profit, right? And then when they ended up sort of losing their shirt on the banana industry because of some stuff, a lot of technical stuff that went on in Europe, the result was they ended up selling off half their banana business because they realized they weren't making that much money in half of their farms. So you always have to be thinking, what's the mix of products and services that's going to get me the most money? Okay, so one thing, oops, it's still skipping around here. I don't know why it's doing that. It's not liking me today. Wow, I'm pushing the up button and it's going down. There we go. So volume versus profit margin. So the thing is, you might sell a lot of goods or services, but if you're not making much on them, on each one, then your profit margin is not going to be all that great. So your revenue might be high, but maybe your net income is going to be low. So you have to think about that. So types of expenses. One is a fixed expense. That's what you have to pay every single month. It might be rent, utilities, insurance. These are things that whether you have one customer or a million customers, you pay exactly the same amount. Now, granted, if you go from one customer to a million customers, you might need a bigger space, and then you might have to pay more rent. But in the short term, it's not going to change. So variable expenses normally change given how much business you're doing. If you're selling more products, then your cost of goods is going to go up because you have to pay something to make those goods available. Even if it's a service, you might have to hire more people to make the service available. And so those are the variable expenses. They can change from month to month, from day to day. They can change all over the place, usually based on how much business you're doing. So capital expense is a big expense for real estate, heavy equipment, any large purchase, large durable purchase would be a capital expense. And then operational expenses, it looks like I got a little note here. So operational expenses are expenses that a business incurs, sorry, just a second, floating meeting controls, through its normal business operations. Those are the rent, the equipment, the inventory costs, the marketing, payroll, insurance, etc. So all these four things are not necessarily, what shall I call them, mutually exclusive, because some of the variable expenses are in the operating expenses. And again, if there's any questions or comments along the way, feel free to put them out there. Come on. Now it's your turn. So I'm going to go and put something in the chat. It's going to be a link to this income statement template, and I'll also show it on the screen. Let me get that for you. And these are on the slide, so when you get them, then you'll have them in addition to getting them here. So here's the link. So what I'd like you to do is to go into the chat, click on that link, the income statement template link, and I'm going to show what that looks like. It's either the same thing or something very similar to something you've seen before. And what I'd like you to do is to make a copy of it. It's a Google document. And then put whatever information you have about October 2023 for your business into that form. And if you're not in business yet, then just estimate the numbers that would go in there. So I'd like us to take 5 minutes and I'll check in with you and see how you're doing. If anybody can't get that access to that sheet, let me know either in the chat or shouting it out, because I want to make sure that everybody can access it, and then try to put whatever data you can in for the month of October of this
Hello,
year.
John. I went ahead and copied and pasted it into the chat, but I think originally you sent the link to just the host and panelist.
Oh, I'm sorry.
Yeah,
Thank
no
you very
worries.
much.
Mm-hmm.
I'll change my setting for next time. Oh, wait. How can I? Oh, I can. Here. Okay, so is there anybody who cannot access the document or and use it? You might have to make a copy of it. I think you do. So I'll give you another 4 minutes to put in some information about October, and I'll check in with you and see how you're doing. I forgot to mention, you can estimate them. They don't have to be the exact amounts. The idea is to get practice using a spreadsheet like this.
I'm sorry, I think you mentioned it earlier that we would have to copy and paste the document over into
Yeah.
Excel.
No, you have to you can make a copy of it as a Google Doc. Just if you
Okay.
let me show you how to do that. So what you do is you go to File and then Make a Copy.
Okay. It was just not letting me edit it. I
Even
don't know
once
if
you
it's
even once you made a copy,
no, it was in that one.
right? You have to make a
Okay.
copy of it. Because if you started editing it, if everybody, then you'd be putting in numbers and everybody else would be trying to put in numbers all the same one. So you have to make a copy. So that's about 5 minutes. I just want to check in with people. Um, and I know in a situation like this, some people might be putting numbers in, some might not. But those of you who are, if you think it'd be valuable to take a few more minutes to put more numbers in now, please let me know. You can put it in the chat, or you can just say, I need more time.
I was just going
Uh,
to mention that just
mhm,
taking a look at the spreadsheet as an
yes.
example
Hmm.
has really given me insight as to things that I should be looking out for. Because I was just thinking of money coming in and then like rent, but really didn't think of like depreciating expenses and other things like that. So
Hmm.
that's a little eye-opening.
Good, that's helpful. I'm glad that is. And think details like somebody asked a question about depreciation expenses. That is over my head, which is why Colleen is here today. So, Colleen, you can address that now if you want, or you can talk about it
Sure.
later when you have.
So depreciation expenses are going to be generally once a year. You can do them monthly, but what I find is once a year you take your capital assets. So that would be those items that are a larger expense that with the IRS rules must be stretched over a period of time. So depreciation is just a fancy way of, for example, you purchased a vehicle for your business. That vehicle cost you $20,000. You may not expense that entire $20,000 within the year you purchased it because that vehicle has a lifespan. So that lifespan, that becomes the vehicle is put in as a capital asset on your balance sheet. And then that lifespan is called your depreciation expense. And it is done over the life of that vehicle, piece of equipment, etc. So in that case, if we assumed that that truck had a 5-year lifespan, we would divide the cost of the truck by 5 years, and each year that would be the portion that you would be able to put into your depreciation expense. Now, over that, if you wanted to do that on a monthly basis, you could take that annual amount, divide it by 12, and that would give you your monthly depreciation expense.
Okay. Thank you so much. I'm going to assume that people have had enough time to do this. The idea here is not to do the entire statement, but just to start getting a feel for how you would do it, right? Because then you got, all month and all year to do that. Okay, so what I'm going to do is go back to sharing the screen. I'm sorry, I'm already sharing the screen, but put the slideshow here. Get rid of the floating meeting controls. And now I'm going to move on to, well, let's see if there's any questions before we move on to the next topic. Any other questions? Don't see any. So I am going to move on to the next part. And the next part is the balance sheet. So that's another core financial statement. It shows assets, liabilities, and equity. And there, just like the other one, there's a link to the Corporate Finance Institute, and it gives you all kinds of information about that. And by the way, shareholders, that doesn't mean it has to be stock, right? Shares of stock. It's just whoever owns the company, whether it's just you or you and a partner or you and multiple partners or however it's set up. So it explains what it is, and it talks about the fundamental accounting equation, which is assets equals liabilities and equity. That's the balance sheet. So this is where you put your credits, the total asset, all the assets, And this is where you put your liabilities, but then what's left over is what you actually own in the business. So you can see there's current and non-current assets, current and non-current liabilities, and then there's share capital, like what you own, and then also retained earnings that you might reinvest in the company. So there's all that, and then there's an example which I'll show you, and you can download it, but I already did. And so now I'm going to show you that one, and I'm going to put it in the chat for everybody. The balance sheet template and a link. And what you can do is, oh no, I'm actually going to show you some more before we go there, before I ask you to do it. So let me show you the video, because we haven't said much of anything yet, and then a couple of examples, and then we'll go on to your turn. So here's the video.
In order to understand what makes up a balance sheet, we need to define a number of terms. Let's begin with the assets side of the balance sheet. Assets are things that a company owns. This includes cash in the bank, furniture in the office, and equipment and technology that's used to create goods or services. Assets are organized into two groups. The first is current assets. Current assets are assets that are expected to be used within 1 year's time. They include things like cash, inventory, and accounts receivable. The second category is non-current assets. Non-current assets are expected to last more than a year's time and include things like property, plant, and equipment, technology, patents, trademarks, etc. Non-current assets are typically grouped into two categories: tangible and intangible assets. Tangible being those that are physical, like property, plant, and equipment, and intangible being those like patents and trademarks that are not physical. By totaling the current assets and the non-current assets, we arrive at the total assets of the business. This forms the left side of the balance sheet, which must equal the right side of the balance sheet. Moving on to the right side of the balance sheet, we have two categories: liabilities and shareholders' equity. Liabilities are what the company owes. And just as with the asset side of the balance sheet, those liabilities are broken down into current liabilities, those that are due within 1 year's time, and non-current liabilities, those that are due in more than a year's time. Current liabilities typically include accounts payable, which is the amount owed to suppliers. Whenever a company purchases something on credit, it results in accounts payable. Most suppliers provide anywhere from 30 to 90 days as their terms for payment. So a company will have an accounts payable balance that is expected to be paid off, typically within 30 to 90 days. On the non-current liability side, things like long-term debt, which would be any loan that's due in more than a year's time, are recorded here under non-current liabilities. By adding together all of the company's current liabilities and all of its non-current liabilities, we arrive at the total liabilities line on the balance sheet. The shareholders' equity section is what the business is worth after all liabilities have been paid off. At the beginning of a business, the shareholders' equity is equal to the amount that's initially invested in the company. This is referred to as shared capital. The investors get common shares in exchange for providing money or capital to the business. Then, over time, the balance can go up or down as the company either earns profit or records losses. If the company produces a profit, that net income flows into shareholders' equity as retained earnings. Those earnings can be retained and remain on the balance sheet, or they can be paid out in the form of dividends, which reduces retained earnings. If losses are generated, those also reduce the retained earnings account. So retained earnings is essentially a running total that shows how much profit the company has generated, less any losses, and less any dividends that have been paid out. At the end of the day, the total shareholders' equity value must be equal to the total assets minus the total liabilities.
Okay, so I did put that, let's see if there's anything more I need to cover before we start. So here's an example, right? It's similar to the one we saw before. You can see that there's a set here, income statement, balance sheet. This particular example is for some company in 2017. Here's another example. So you can see they can look different as long as you got the main stuff in there, right? Assets, liabilities, and equity. So what I want you to do is now is the thing I put in the chat, the balance sheet template. I want you to open that up, make a copy of it, and then put the information about 2023 for your business into it. You know what? Let me ask before we do that. If you would, please put in yes or no if you put any numbers into the income statement template that we used before. Please put in the chat yes or no. Because if everybody says no, then I don't think we need to take a break for people to put them in here. And if some people say yes, then we'll do it. We'll take a break. Okay, we got 2 no's and no yeses. So unless we get any yeses, instead of giving you time to fill it in, what I'll do is give you time to do what Lucia did, which was to review it. So let's do that. We'll just take about 2 minutes. I'll put it up on the screen as soon as I find it again. Where is it? Why am I not finding it? Here we go. This is, which was this? That's the income statement. This is the balance sheet. So I'm going to put it up on the screen, and so but do make a copy of it so you'll have it. But go ahead and take a look at what all the different categories are. Make it a little smaller, so hopefully you can see everything at one time. There you go. So just imagine if you were trying to put numbers in here, what that process would be like. So we'll
John,
yeah.
so I'm noticing that this form is per year rather than monthly,
Correct.
than the other one. Okay.
Uh-huh.
So are we filling this out like when we're doing our taxes, or when would be an appropriate time to fill out this one?
Well, you're going to be doing it. You're going to make sure that you have the previous years and possibly forecast for future years anytime you're going to go to get a loan or an investment.
Okay.
But also, let's ask and see if Colleen has a comment about when you might fill out your balance sheet.
So typically, Lucia, you're going to do this as your entire financial package. So your 3 reports, your balance sheet, your income statement, and your statement of cash flows. You really should be reviewing these monthly. So as I talk about this, I'm going to talk about the map, which is your chart of accounts that creates these reports. So that is your roadmap to your actual books. So to your set of books. If you are a small business, a sole proprietorship, you're just starting out, you may find that you're able to be very lean in your accounting practices, which meaning that you may only need to update them once a month. As you get busier, you may want to revisit that and say, hey, I'd like to update this more often and see what my trends are as far as sales versus expenses. Again, all of that is going to feed back into that balance sheet as well, because the balance sheet and the P&L are actually very married together.
Okay, thank you so much. Okay, so let me get over to the slideshow again, and we're going to move on to the cash flow statement. So that's the last of the three core statements. And I'll put it back on full screen here. And get the floating meeting controls out of the way. Okay, so that the definition here is another core financial statement. This time it shows the net inflow and outflow of cash. So let's take a look at the information on the Corporate Finance Institute. It says what it is. You can download it, why it's important, some definitions, etc., etc. So hold on, what do we have here? So that's cash flow, operating activities, investing activities, financing activities. So those are the things that use money, right? That use and produce money. Okay, so what I will do is now go on to the next step here, the video. So let me show the video.
In theory, it is not necessary to have a cash flow statement, as all cash items could be recorded on the balance sheet directly. However, in practice, that is not practical, and only the closing cash balance is shown on the balance sheet, while all other details are shown on the cash flow statement. Understanding where cash comes from and how it is being used is very important for managers of the business, for financial analysts, and for other users of the financial statements. The cash flow statement organizes cash inflows and outflows into three categories. The first is operating activities. The second one is investing activities. And the third one is financing activities. Let's take a closer look now at cash flow from operating activities. This includes items that are found on the income statement, such as revenue and operating expenses. However, it only includes them if the cash payment actually occurred in that period. So, for example, it just includes revenue that the company has actually received the cash for, and it just includes expenses that the company has paid out the cash for. So, it's similar to the income statement or statement of operations in that it reflects revenues and expenses from the period, but it's different in that it only reflects them if actual cash movements occurred during the period. Now let's take a closer look at the cash flow from investing activities. Investing activities include things like purchasing property, plant, and equipment, or selling those assets, as well as making investments in other businesses, or acquiring or divesting of entire businesses. This is where a company records its capital expenditures as well as M&A activity. If we take the cash flow from operating activities and we add the cash flow relating to investing activities, then we arrive at the net cash flow before financing activities. The final category on the cash flow statement is cash flow related to financing activities. This is very distinctly different from operating and investing activities. This includes things like issuing shares, raising new debt, repurchasing shares or repaying debt, as well as paying dividends. Finally, if we take the cash flow from operating activities, add the cash flow from investing activities, and add the cash flow from financing activities, then we finally arrive at the net cash movement over the period. This is the total change in cash position for the company.
Okay, let's close that off and that off, which we don't need anymore. And that, which we don't need. Come on. Huh. Okay, and now let's go. I'm sure we're going to just close one more, so I just have a simpler screen here. And now we're going to go on to the next one. So here's an example, right? So you've got cash flow for a certain period of time, a month, this particular month, cash flow from operations, cash flow from investing, and cash flow from financing, and that's what you end up with. Okay. So here's the cash flow statement. Did I already put? I can't remember now if I already put that in or not. Maybe I didn't put it in the chat yet, but I will
Not
put
yet,
it in.
John.
Okay, I will put it in now. I had it on that other sheet, but I got to copy it again. So now I got to get back to the chat, put it in. So this is just for you to review. And it will be on the spreadsheet, but on the slides, but I wanted you to get a copy of it now so you can take a look at it. But here it is. And so again, this is something that you would do for each year, or I think Colleen said you would do it every month. But these are the kinds of things you need to put on the cash flow statement. So Colleen, any other thoughts about this before we move on?
The cash flow statement is going to be more of a metric that you would use. So external sources like banks, venture capital, any other outside financing operations, your CPA will all look mostly at the balance sheet and the income statement. The statement of cash flows is really going to be useful for you on an annual basis, but you could also even break it down to a monthly basis and see where your highs and lows are. So it's a good forecasting tool. If you aren't running a formal budget, then using a cash flow statement can help you navigate and see where your trends are and see if you're having a line of highs and lows, or if you're having more of a straight line trend in your business. And you can make some pricing adjustments and things like that from there. So it can be more of a forecasting model for you.
Okay, thank you very much. So let's see where we go from here. So any questions about any of these three statements before we go on to another topic? Okay, we're going to talk about key financial concepts. So we're going to talk about what different people do, what their role is with money, right? So you might be your own bookkeeper, you might hire a bookkeeper, and I'm going to talk about that a little on the next slide. You will probably need a CPA, either for an audit or for taxes or whatever. And then also the owner, you have a role too. You have to make sure that you understand the finances of your business, at least in a basic way, so that you can have an intelligent conversation with your bookkeeper and with your accountant. So now we're going to talk about the guest speaker, Colleen Morris. She owns and operates Sutter Buttes Business Services. Love the Sutter Buttes. Since most of you are up there, I just can't resist telling you one little story. So when I was a kid, my father had a pilot's license, and he had a friend who had a plane, and sometimes we would fly this plane. I was a little kid, right? And we'd take off from what was called the Sacramento Municipal Field at the time. It's now Sacramento Executive Airport, the little airport in South Sacramento. And he would take off. He says, "Okay, you're the navigator. Now, what I want you to do is go fly right over those Sutter Buttes." Well, it's so easy because it's the only thing sticking up in the whole valley, right? But I thought it was very accomplished. But I love the Sutter Buttes. So while Colleen is speaking, I'm going to go ahead and put her LinkedIn link on her name here, so that when you get the slides, you'll be able to contact her if you want to. And Colleen, please take, I don't know, 15 minutes or so and just talk about anything that you think would be useful to people, for entrepreneurs to know about starting their business and managing their finances.
Thank you very much, John, and thank you for the opportunity to be here with you this evening. I certainly appreciate it. I love speaking to entrepreneurs because we have all taken that adventure together. I have been in the accounting field for 32 years. 9 years ago, I decided to make that jump to entrepreneurship. And it has been a wonderful adventure, occasionally terrifying, but very rewarding. So that said, What I'd like to go through with you, we've heard about all of the reports this evening, and this is some great information. I would highly recommend going on to the CFI website and just spending some time there in getting a little bit more in depth with some of the processes that they line out. But ultimately, what feeds these reports is what's called your chart of accounts. Can also be called your general ledger. So you will hear both terms used simultaneously. What that is your roadmap to your books, to your financial picture of your business. The chart of accounts is laid out in such a way that it begins with the balance sheet, accounts normally, and that would be starting with your bank accounts. So that would be first on the list of chart of accounts. That's, again, going back to the balance sheet, that's an asset account. And then if you had a savings account, if you had any type of petty cash, money market, that would all be in that first banking section. And then you would move down to accounts receivable. This is simply money that people owe you for your goods or services. Below that, you could have an inventory asset if you have inventory in your business that you keep on hand. Some businesses, even if they are creating a product, they may create such a customized product that they don't retain inventory. So oftentimes if it's a craft or even if it's photography, you may not keep actual inventory on hand unless you are keeping stock photos. Then you will have things like prepaid expenses. So if you are paying things at the end of the year, for example, you may prepay your rent because you want to reduce your overall net income for a particular time period. Usually we see this in December. Some businesses might prepay some of their January expenses so that they would bring their net income down for tax purposes. That is still considered an asset because in essence, you're prepaying that expense and it belongs to the next year. That expense doesn't actually belong to the year that you're working in. You can have undeposited funds. So if you collect monies from your sales of products or from your services, and maybe you only do a deposit once a week, you have undeposited funds gives you a way to record those monies and then do a deposit later as a lump sum. So it kind of is a holding place for those funds. And then you will drop down to your fixed assets. Your fixed assets can be equipment, furnishings, land. If you own your own building, any of that will be your vehicles, your equipment, that would all be a fixed asset. It has a life longer than a year. Oftentimes it has a life longer than 5 years. The one condition on that would be software. Software programs typically are expensed out in the year that they are purchased, even if they are a large purchase. So when I say large purchase, I'm saying over $1,000. If you purchase your software, oftentimes it will be expensed in the same year unless that software has a reasonable lifespan. Normally that reasonable lifespan would be no more than 3 years. Software changes so often that they've found that that is not a metric to put into fixed assets any longer. As you move down, you will go to the liability side of your balance sheet. which will begin normally with your accounts payable. Your accounts payable are items that you owe to vendors for their goods or services. For example, even things like utilities, PG&E or AT&T would be an accounts payable. They are sending you a bill, you are inputting the bill, and then you are subsequently paying that bill, maybe the same day, but oftentimes it'll be you wait until you have a few bills and you pay them all at one time. That becomes important from a cash flow perspective as well, because you can use your accounts payable to track how much money you need to outflow from your operating account or your checking account. So you can manage this a little bit better from a cash flow perspective and say, I have these bills coming up due on this particular date. I have a record of them here. So it gives you a metric to keep track of these. Also within your liabilities will be any credit cards that are used for the business. A credit card is a type of payable because it is, again, something that you may be using for business expenses, but you will be paying that credit card bill. And you may not pay it all at one time. So it would be held as a liability until it's paid to zero. Any kind of payroll tax payable, benefits payable that are not paid out immediately would be all liabilities. Payroll tax payable will also be liability in the respect that your employee's paycheck, you have their gross payroll, then you remove the taxes, both state and federal, and that cuts their net check. So when you're removing the state and federal taxes from their net check, that goes into a liability account because it's not your funds, but you do owe that to the state or to the federal government on behalf of your employee. Any questions on that one? Because that one gets a little wonky sometimes for people. Okay. Same thing with sales tax. Sales tax, if you do have to pay sales tax, you are selling a product. Service businesses do not have to pay sales tax on their services. Businesses that sell a tangible product do. I would very much recommend looking at the CDTFA website, which is the California Department of Tax and Fee Administration. They have a very good website and they do have free trainings on sales tax requirements if that is needed in your business. And then your map continues down to your equity account. So we're now at the bottom of the balance sheet. That is the owner's equity. The owner's draw account will also be in here. If you are a sole proprietor, you will oftentimes see an owner's draw account within your general ledger map. And that is because as a sole proprietor, you often will take, instead of payroll, you might take a draw, which just means you're removing money from the account. So say you're not on payroll, but you're going to take $500 every week for you personally, and you're going to remove that from your cash account or your checking account in the business. The other side of that equation would be that it goes against the owner's draw account. That is removing equity out of the business. Then you will also have your retained earnings, which your profit and loss statement will feed into your retained earnings at the end of every period, which when I say period, I mean fiscal year end. Some businesses are on a calendar year for that. Some agencies, especially nonprofits, might do a fiscal year ending on June 30th, because that's oftentimes when their grant period ends. So that is the whole map of your balance sheet. Then you get into the income statement, and the map starts with your income. So anything that pertains to your income, sales, any kind of fees, shipping income, any income that is coming into your business that is not interest income. So if your bank gives you interest income, that goes somewhere else. Any other types of income that come into your business will be the top of your income statement. The next piece of your income statement is your cost of goods sold. We went into in depth. Those two pieces will line up one right under the other. And then we go into the expenses. And I like the sheet that John has up here because it has a really good list of the different types of expenses that you might have on your income statement. You may have advertising, commissions. You may have continuing education if you have licenses, or any type of professional fees that you align with and that you have to continue and keep up. You'll have postage, phone expenses, utilities, rent, bank service charges. If your bank charges you a fee for a monthly statement, that would be a bank service charge. Education and training. We no longer have the entertainment category because the entertainment category was removed from the IRS tax code. So that is no longer available. However, meals still are if you do meals as a work-related expense. So it would have to be a meeting with a client, or it would be, I'm taking the staff for a lunch. Those are the type of meals that are accessible to you. If you're traveling for your business, those travel expenses will be part of your expense list. And then mileage or fuel can be part of these expenses, but you should speak with your CPA about that, because there's times when it is better to take the entire full mileage deduction on your taxes, and then there's times when it's better for you to have it listed out on your expenses as a monthly item. So you may want to seek your CPA's advice on that. And then we come down, what they didn't discuss on the income statement earlier is underneath these net expenses, there will be another line of other income and other expenses. Other income and other expenses would be your interest expense, would be an other income. Your gain or loss on the sale of an asset would be in this other income and expense line. What these are items that drop below the net income line on your profit and loss statement and may or may not be a tax ramification for you for income tax purposes. So those items would drop to that area of your sheet. That's a lot of information in a short span of time. So if you have any questions at all, please reach out to me. We do use QuickBooks in my business. So QuickBooks is definitely our go-to. We use QuickBooks Online specifically, and we find that is a great way to have immediate transparency with our clients, because we can work on everything in live time with them.
Thank you so much, Colleen. I put a link in here. I added the general ledger chart of accounts.
Fantastic. Thank you.
And I'll put here feeds into the three big, what do we call them? Statements, documents. It still fits. Okay, very good. Colleen, thank you so much. I really appreciate it. I never pretend to be a finance person, and it's terrific to have you here to fill in the gaps. So speaking of QuickBooks, that's what we're going to talk about now. So I'm going to talk about some popular accounting programs. First of all is QuickBooks. That's the 500-pound gorilla. Probably more people use that than anything. And there are links in this to all these things, right? Here's QuickBooks. Intuit there, but it's by Intuit, and Intuit also does TurboTax. I've never used QuickBooks, but I gotta say I love TurboTax. It has made my life so much easier. Then there's another one like QuickBooks called Bench, and there's others, but to give you a couple of examples here. So again, these are popular accounting programs that you can use yourself, or you can hire a bookkeeper or an accountant to use for you. So here's some planning resources. So SCORE, this is Senior Corps of Retired Executives. They have a financial projections template that you can use. There's something called Live Plan that you can use. I'm not going to go into all these cookies and everything. I'm just showing you where the links go. But you got to make sure that the information you put in is correct, because the old saying is garbage in, garbage out. And as you can see, this person with crossing their fingers says, yes, sir, you can absolutely trust those numbers. But you got to make sure you trust the numbers that are going in so you can trust the numbers that are going out. Okay, so you want to review financials on a regular basis. Colleen said it's important to do it monthly. So this would be an example, right? It shows you promotional, for example, this is a particular one. Promotional, I think it's expenses, printing expenses, binding expenses, and royalty expenses. So that would be probably some kind of a publishing firm, right? So that'd be like a dashboard for that firm. Okay, so I think our last major topic before we wrap up is practical strategies to improve cash flow. So there's three top rules in business. Rule number one is never run out of cash. And rules number 2 and 3 are remember rule number 1. Never run out of cash, because if you're out of cash, unless you got some way to get more cash, you're out of business. So never run out of cash. So let's talk about we talked about how can you increase revenue in a small business, but now I want you to do a quick brainstorm, either shout it out or put it in the chat. How can you decrease expenses in a small business? Just throw out your ideas.
Maybe look at your overhead.
Absolutely. If you can cut down on rent or utilities or other things like that, absolutely, that's a way to reduce your expenses. Any other way to reduce expenses? Somebody's got an idea in the chat. Do it yourself. As opposed to paying somebody to do something, you can do it yourself. Any other ways to reduce expenses? Okay, terrific. So let
Well,
me
John, actually,
Yes.
one more.
Yes.
I'll give you one more source on the bookkeeping side. If you are still at a smaller level, there are a few programs out there that are online cloud-based programs that operate similar to QuickBooks that are free and do have free versions. One is called Wave. And so if you want to take some time, if you are doing the do-it-yourself, the bootstrapping portion is how it's called, and you're not getting venture capital or angel investors or bank investments. You're not at that point yet. Look at some of these items, because they can really take off the soft cost of your business overhead. So anytime you can get a subscription that might be free rather than paid, it might be a good idea to start there.
Terrific. Thank you so much. Okay, so here's some other ideas. So if you can anything to reduce your expenses, if you can eliminate an expense, great. If you can reduce it, that's also good. And if you, even though you can't eliminate or reduce it, if you can get more value out of it, then that's good for you because you maybe get more revenue, and so that way you have more profit, even though you might not have, in that case, reduced an expense. Okay, there we go. Okay, so when you want to eliminate or reduce expenses, you want to start with the largest line items first. So I want to give you some examples of some of the largest line items. They include wages and benefits, management expenses, wages and benefits, rent or mortgage, equipment, utilities and office supplies, and then there's a whole bunch of other things that cost money, right? So start with the biggest ones and try to reduce those, because that's, obviously you're going to get more bang for your buck that way. Let me close these to not confuse myself. And there we go. Now let's move on to the next. Okay, so how do you play the cash flow game? Pay at the last moment and collect fast. It's sort of like the basic principle in business, which is buy cheap, sell dear, right? But here, pay at the last moment and collect fast. And that way you're going to have more cash in the bank. Okay, and try to keep your debt payments current. Now here it says, this was in the slideshow that I was given. I've edited this, but it says, don't worry about paying down principal. Now, I put a question mark about that because I'm not so sure. So I want to hear what Colleen says while I see what the other item is in the chat.
Oh, the question is, can Wave be imported to QuickBooks as the business grows? Yes, it can.
Great.
So
Mhm.
paying down debt principal, there are two schools of thought here. If you have a good interest rate and a long interest rate, so for example, the EIDL loans that came out during 2020 were a long-term 30-year at a very low interest rate, it does not necessarily make good cash flow sense to pay that principal down quickly. Because the only thing that you can write off from a tax perspective is your interest. So if you are paying that principal down quickly, you have the benefit of paying that loan down, but you have no tax benefit to that. Whereas if you have not a concern about cash flow, you have enough cash in the bank, and you want to make larger investments, or you need to get venture capital, angel investors, you want financing for your business because maybe you're expanding or maybe you're developing a new product, then you want as little debt holding on your balance sheet as possible, because that is going to look better to those lending institutions that you're looking at. So that's when you may want to say, hey, I'm carrying a couple of small loans. Maybe I have a vehicle loan on my business. Maybe I have a operating line that I got when I first started out, and I don't really need it as much anymore. Maybe look at paying those principal balances off before you apply for more lending.
Okay, thank you. So you want to be proactive instead of reactive. So don't wait for trouble to fix, prevent the trouble. So that's why forecasts are so important. That's why trends are so important. You want to keep track of all that. Okay, so last thought, financial knowledge is power. Don't be intimidated, be in control. So I think we have a little bit of a wrap up here. Let's see if there's any last questions before we end. Anybody at all? In the chat or out loud? Okay, I want to thank everybody for their participation. I want to thank Joseph for all the logistics, both tonight and prior to and after this event. Colleen, for your really valuable insights that you shared. Thank you so much throughout and then the time that was allotted to you. And so hopefully people have got both takeaways and action items. So here is a very important slide. You'll see it's a little more extensive than in the previous sessions. First of all, I want to remind you, you can work with a a business advisor. There's about 15 of us in Sac Valley SBDC. I mostly work with business planning and a little bit on marketing. Other people work on that or other things. And there's some people with lots of financial savvy who you can get through the SBDC. We don't charge anything for any business advising services. And you can sign up for more SBDC online trainings or even in-person trainings. I should take the word online out of there because some of them are in person. Most of them don't cost anything. Some of them, there's a relatively small fee. And I want to point out a couple of them that are coming up because they're right on topic, right? Smart Finance for Small Businesses, Financial Management 101. So it's 2 hours a night, sort of like this, but a half hour longer. And it's on Tuesdays in November. Now, the first one was yesterday, but you can still, I'm almost certain, sign up for the last 3 sessions. And if you're too busy in November, or you want to do all 4 in the same order, if you want to do the first one, if you missed that and you want to do the next 3, it's coming up again in the first and second quarter of 2024. I don't think it's on the schedule yet, but if you go here, you'll find it. If you go here, you'll find it for even in the first and second quarter. So I think that might be. Oh, so we were supposed to get closing remarks from Brenda Stanix, and I don't think she's here. Is she here? Nope, not here. So I don't know, Joseph, you want to do it? People are probably tired of listening to me. You want to give some final remarks before we end up?
Yeah, no problem. Just want to thank everyone for joining us tonight. I want to give a huge thank you to John for being with us throughout the whole series and sharing his expertise. I want to give a huge thank you to Colleen for being with us tonight and being able to fill in the gaps for John and giving that great information and all that, the great resources to the attendees tonight. Stay tuned to our website and our social media platforms. And if you haven't already, sign up for our newsletter on our website. You'll receive all the different trainings that John mentioned. You'll be the first to know when those trainings go live, and you can register for those events. There will be a survey that'll pop up as soon as you exit the training tonight. And you'll also receive that survey link in the follow-up email, along with the recording and slides mentioned, and any relevant links that were mentioned throughout tonight's presentation. So I just want to thank everyone for being with us tonight and being with us throughout the whole series, throughout the 5-week series. It's been a great pleasure to work with you, John, and thank you very much. And if you'd like to sign off, say a last couple words, and then we'll go ahead and call it a night.
Well, again, I just want to say thank you to everybody for your participation. Some of you might have been here all 5 weeks. Some of you have been maybe just tonight, but it's great to have all of you. And thanks one more time. Here's the survey popping up right now in the chat. And thanks one more time to Colleen for tonight, and Joseph for every night and every day that you've worked on this in the past month. Thank you both.
All right, everyone, have a great evening. We'll see you at the next event.
Bye.
Thank you. Good night, everyone.
Bye-bye.
Thanks, Colleen.